Hello, everyone. Welcome back to CLI's Women Legal Business Founders and Leaders series for 2022. I say for 2022 because this is our final one for 2022, but we will, of course, be back for 2023. I'm Terry Mottershead, the Executive Director of the Centre for Legal Innovation at the College of Law, and I will be your host today. I'd like to start today by acknowledging the traditional custodians of the lands on which we meet, all of the lands on which we meet. We pay our respects to their elders past, present and emerging, and acknowledge all Aboriginal and Torres Strait Islander peoples here today. Welcome, welcome, welcome. The session today, we're going to be dealing with obviously one of the most fundamental business issues, which is funding, and particularly funding for women-led businesses. So we're going to get into all of the tips and the traps with our, as I said, our amazing panel of women business leaders. And let me welcome them for you now. Janiyah James is a partner financial advisory at Grant Thornton, Australia. Good morning, Janiyah. How are you?
Morning. Very well, thank you.
And Barsha Rubin, who's the CEO and co-founder of Priori Legal. Hi, Barsha. How are you?
Good, thanks. How are you? Thanks for having me.
Absolutely a delight. So we've got folks from two different continents, from Australia and from North America, from the United States in particular. So it's just great to have you here. I wanted to kick off with, I guess, the very first question that everyone wants to ask when they think about funding, but I'm going to ask you to draw on your individual experiences, if I may. And that is, you know, as business owners, you've no doubt had to encounter and think about some pretty fundamental things in terms of funding, or made some fundamental choices. So as you were thinking about this, as you were kind of setting up your businesses, or indeed as you have expanded your businesses or advising others that have been doing that, what's kind of been on the top of your pros and cons list to consider when making the choices that you made? And I'm going to get you to kick the session off, Barsha, by asking you to address that first.
Yeah, so thank you so much, and thanks for having me. Love being here. I love the work you're doing, and also I think this is such an important topic because for so many startup founders, the knee-jerk reaction is that venture capital financing is the automatic route to go. And also venture capital dollars raised is considered, it's almost a vanity metric. You know, I raised $100 million and asterisk footnote sold 30% of my company.
Yeah.
And I think that when you're starting out, I really encourage founders to think pretty seriously about the business they're trying to build, what their goals are, what capital they need, and what their exit plan is. And I say this as someone who did ultimately decide to raise venture capital. We raised $15 million over the summer. This is our third round of VC financing. Yeah, it was. Thank you. Very good timing, as it happens.
Yes,
like I should have also put down a lottery ticket. But when we first founded the company, we didn't raise money. And there were benefits and drawbacks to that. The benefit is that it gave us a lot of time to iterate on the business model and figure out really find product market fit before we brought in external investors. On the other hand, it meant that we were off the typical track. And that as we did decide, and this is something that I do also, is one of my lessons learned, it is not as easy as you might think to go from being a non-venture backed business to a venture backed business, not because of anything internal necessarily, but because your metrics don't look like what a venture backed business who's been in business for 3 years look like, because you didn't burn $5 million in the process of building. And so those are some of the things that I think about, but I think the first blush reaction is to think about the purpose and raise as little money as you possibly can in order to achieve your goal, because every time you raise money, you are diluting yourself, and you are bringing in a cacophony of external stakeholders.
And Barsha, just to place that in context, tell us a little bit about Priori Legal.
Yeah, I guess I probably should have started there. We are a legal marketplace for in-house teams to find, hire, and manage a global vetted network of attorneys at firms of all sizes. So think at its most basic level and Uber for legal services. But obviously quite a bit more complex than that. We were founded in 2013. We only raised friends and family financing for the first 4 years we were in business. And it was the right decision for us at the time. And I don't believe we would have accomplished everything we'd accomplished had we gone and raised money on day one, but that is not a decision that came without some grief along the way.
Fantastic. Thanks very much. And Janai, let me ask the same question of you, kind of things, the pros and cons, I guess, to consider when you're making your choices. And tell us a little bit also about Grant Thornton.
Well, I'll start with Grant Thornton because that's the easy topic. So I'm a partner in our financial advisory corporate finance practice, and we're responsible for really assisting mid-sized businesses in achieving their growth aspirations, whether it's through raising capital, M&A, or any other way of or strategic advice, really. And my particular focus is helping clients understand their value, and really what is driving that value. So sort of with that lens on, we find ourselves advising a lot of clients in the capital raise scenario. And I want to touch on a couple of things that Barsha just said, and I think that the really important one was around knowing what you want and knowing what you want to achieve. I think that's really important, and particularly when you are looking for an investor. What we do typically see, and Barsha was absolutely right. We always encourage clients at their very early stages to really focus on that family and friends network. Get whatever cash you can generate within the business to reinvest in it, and take that, I guess, more conservative path. And that's for the exact reasons that Barsha was saying, was around dilution and determining, making sure that you still have control over your own business. And part of that, if you are starting to look for an external party, the key thing to actually think about is whether you actually want a partner or whether you want a funder. And they can be two different things. A bank is more like a funder. They're just providing you with some cash with some covenants that attach to that. Much more difficult to get in early stage. Or are you looking for a partner? And often, to the point that Barsha was making about VCs want to get involved, that they need to make sure that the business is achieving the metrics that they've planned as part of their exit. So I think making sure that you've got that fit and understanding that that not all investors are the same, and not all investors will want the same thing. And so an investor that has the same goals as you have is really, really important.
So I want to ask you both a follow-up question, because it was directly to something that you've both said, which is knowing what you want. But I wonder if, if you're first starting out a business, it can take a little bit of time to work out what it is that you want. And so does that mean, and I know we're going to get into kind of different types of funding in a second, but does that mean that you are effectively looking for different types of funding at different stages of your business as what you want becomes more refined, or that you really just need to stick with friends and family until you get to the point of having refined your idea or your concept or whatever the case may be? So let me throw that one first to you, Barsha, but I would really like to hear your thoughts on that as well, Janai.
So I also want to hear Janai's thoughts on it. Here's how I would suggest thinking about it.
Yeah.
Is there a path to doing $100 million in annual revenue?
Yeah.
And is that what you were like, first, does the path exist regardless of whether you wanted it? Like what would need to happen in order you're selling widgets at $10 a widget? How many widgets would you need to sell in order to get there at its most basic level? And if the answer is that is a business of a size that is uncontemplatable for you, or that you don't see in any short-term way, venture is probably not the right route for you. That is what VCs are trying to solve for at an early stage. They want to be able to see a path from your seed stage business to a business that is doing $100 million of revenue. And then the question is that what you want?
Sure.
I think it's such a big, you know, in our modern Silicon Valley Hollywood, right? Like that's the dream. Like I dropped out of Harvard and then I, you know, and then I started a business, and whoops, all of a sudden it was worth $10 billion. I was just in my garage. But that is not what everybody wants. That's not the only kind of business that exists. In fact, that's a moonshot. That's winning. That is like, you know, being drafted to the NFL. Oh, we're talking about, or some appropriate Australian sports analogy. But you know, there are a lot of businesses that make people a lot of money and provide them with a lot of satisfaction that do $10 million of revenue a year, that where the founder is very well off and living, you know, and living in a way they want to live and engaged in interesting work. And you know, I actually had a founder friend of mine who was very, very successful, unicorn business multi times over, said to me, which was very powerful and has stayed with me over a number of years, Basha, knowing what I know now, I would rather own 100% of a business that's worth $10 million than 1% of a business that's worth $1 billion.
Absolutely.
And I think that is a set of questions that you can ask yourself in the earliest days. Like, first of all, is it even possible with my business model? Like, what would need to be true in order, like, you know, I'm selling something to small law firms for $20 a month. How many small law firms are there in the US? Like, what would the add-ons need to be? What would the path to that be? And then to have a really honest conversation with you. Are you going for that moonshot? Or is there a different kind of business you want to build? Because I think that really militates toward different funders, different structures, and different early stage decisions. But Janaya, you are the expert.
Yeah, absolutely.
But I think you're absolutely correct. And I think that the interesting thing is that there is horses for courses. And so, you know, going to Basha's point around, if you want a $100 million business or $1 billion business, then yes, potentially VC is the answer for you. Because if you think about, you know, venture capital and some of those investors, they're after a return. They're taking the risk on you and your business, and they want to get the, you know, the payoff for that.
Sure.
So naturally speaking, if you're going to go down that path, the VCs are really looking at something that is going to grow, and it's going to grow exponentially so that they get their high return on it. But look, I think there are different things for different stages, and you know, at the end of the day, a VC or a private equity or whatever type of structure, you know, they're going to struggle investing in a sole proprietor business that's very early stage. You know, you do need runs on the board. It's not as simple as, you know, knocking on the door of a VC and saying, right, I've got this great idea, invest in me. They're looking for runs on the board. They're looking to see that what your idea is, what your product is something that has a market, is something that is going to achieve those that growth. You know, and if it's not something that's going to fit in that's where you rely on different sorts of funding. You know, legal professions, you could be looking at bringing in other partners, for example, and they're funding the equity, bringing in the business that way. You know, that's a more traditional partnership model. You know, that it is very much business specific and stage specific. You know, if you are at that 100 million, 200 million level, then, you know, you've got a whole raft of possibilities open to you. But as an early stage, it is very limited. And look, that's where that friends and we talk about that friends and family, or known high net worth individuals from your networks. That's where that comes in, because they're investing in you, as opposed to this amazing story that's going to get massive returns. And look, and that's why so many businesses, their first few years are really that family and friends, because they're the ones that believe in you. They're the ones that have that perspective around they wanting to support you and what you're achieving, and with any luck, get a return on it.
Yeah, but it does go back to what you're both saying about being really clear about that purpose, because you've got to understand what it is you're selling, right? Whether you're selling effectively your own reputation and your product, or whatever the case may be. By the way, after this session, I am going to go and check my garage again, but I don't think there's anything worth $100 million happening in there. But I will go and check it out. But I think I'd be pushing it to get $1 in any currency, actually. But we'll try. I mean, all of this does lead me into my next question, which is, do we tend to think about funding too narrowly? Do we, and maybe this is just the way that it is, to pick up on some of the points that you've both made, that there is very much a convention almost of certain types of funding for certain types of businesses at certain types of stages. But the question that I'm asking is that right? In other words, is that convention really set in stone? Or are there broader and greater opportunities? It's just that we're used to operating in a certain way, and so we're not creative enough about that. So, Janira, I want to start with you on that one first.
I think there's an element of convention that is involved, and I think it's if we go back to one of the points that Bash made earlier around people want the unicorn, they get the VC in. It's seen as the ego to get the VC in. It's not necessarily the right thing for a business, but also we tend to think narrowly, and that's really because that's where some success has been achieved.
Sure.
And so the idea is to go to those those avenues, because that's where a competitor over there or business over there has achieved success. We would tend to look at it, in a different way. So, for example, one would be to say, right, you've got this business, in legal tech. Is there a larger organisation that would use your product, but also want to invest in that, so it actually gives them the benefit through the use of the product or whatever it might be? So it's also thinking strategically. It's like, it's not necessarily banks, VC, family and friends. There are other options. They're not as widely known, and that they are options that come with risks as well. So similar to VC, if you're sort of saying having a vertically integrated investor come in, then perhaps again you're gonna have to give up. And I've also seen that fail dismally. So, for example, I know one business where a large technology company invested in their VR technology. It's great VR technology, fantastic, but ultimately they invested to get hold of the technology and then basically bring it into their own business, and then say, oh, we've effectively reverse engineered the product, and now we're going to compete directly with you because the investment was so small. So it does have its downfalls, but I think thinking broadly does help. It isn't easy. As we'll keep reiterating, that the earlier the stage, the harder it is to get any funding. And we keep going that you need to know what your value proposition, but you also need to have some track record. It may not be profitable, but you need to be able to demonstrate that you have been able to penetrate markets and so on. And so that's the sort of thing that is really important. And that's where the verticals may be an option, is because they may be able to use your product in their business and naturally create a market for it.
Some of the folks that are listening to this won't be in the startup world of the legal tech nature
Yes.
is what I mean. So for those folks, it might be, you know, starting a boutique law firm, or, you know, basically they've got a bunch of friends and they'd end up with a slightly larger law firm. Is there only possibility for funding, you know, basically an overdraft facility in a bank? So what else can they look at? Because I think that's probably where they'll go. Yes, they'll put in money, but they, you know, they're going to need some other money too.
It tends to be the most practical.
Okay.
But I guess, you know, a law firm is slightly different than it's people generated.
Sure.
And so, you know, more people generally means more profitability. So, you know, the traditional path is bring on more partners if they're aligned to the business and grow. And with bringing on more partners, you get additional equity in, but also the ability to actually create that return on equity. I mean, that is a traditional path. We have seen, you know, some law firms with varying success, you know, go to the stock markets. Again, I probably wouldn't recommend that. You need to have massive scale to be able to do that.
Yeah.
But look, you know, I think, you know, and you have things like litigation funding as well. So
sure.
If you're doing stuff like class action work, for example, you know, that's where litigation funding comes in. It supports your business, and then, you know, you can get that, you pay on success. Look, I have seen other sorts of structures in legal firms where it's a type of bank funding. It's sort of a quasi-equity funding with strategic partners, but they can be quite onerous. So, you know, I think if you are going to go down those sorts of paths, is really understanding what that structure is going to do. So, for example, in the example I used, you know, they were taking something like 90% of the profits for the first 5 years.
Okay.
And, you know, it is a high risk, but, you know, if you grow over that period, it's like, well, we're actually giving everything away and not keeping anything for ourselves. So it's actually trying to create that balance. I can't say there's a one size fits all, but, you know, I think for early legal practices, the traditional paths are probably there for a reason. Because that's, again, going back to my earlier point, that's where the success lies.
Yes.
That's where the funding has been achieved. But again, I think the key is don't overdo it. That's when people get into trouble. Don't get too much leverage. Really understand what you're able to achieve, so that the leverage or any equity investment is something that is achievable. And not going to dilute you too terribly.
But it also seems that you're saying, and correct me if I'm wrong here, you can be creative and think about a bunch of different options, although the ones that may end up being the most successful are the ones that are quite common and tried and tested.
Well, and the reason for that, so for example, banks, you know, banks know the legal profession. So they've had success out of the legal profession, so they'll invest again. Trying to get someone who hasn't been doing that or doesn't understand the profession, it's going to be much more challenging to get someone to put their hard-earned, or a organisation to put their hard-earned, if they don't understand, you know, the business that you're in.
And they've got other businesses that they're more familiar with that they can invest in.
And that's a really good point, because it's a real competition for funding. So, you know, it's capital that there's lots of capital out there, but if you sort of think how many businesses are out there trying to scream for that same capital, you know, it's tough to differentiate yourself. And equity investment really needs differentiation. Whereas relying on sort of, you know, overdraft facilities and stuff like that, you don't need that differentiation. You just need to make sure you've got a strong business and strong balance sheet. So it's simple, and it's not very creative. and there are creative options out there. It's just that you need to think very, very carefully about some of those creative options, and whether some of those options are going to be right for you and right for you in the long term, because sometimes they're very difficult to unwind.
Yeah, absolutely. Barsha, you know, you live in startup world and you've been very successful, as you're saying earlier, in raising funding. Do you think people are creative enough about options, or, you know, I think, is it just the tried and true, and that's where you've kind of the lane you've got to stay in?
Yeah, so I think that one thing that Janaya didn't mention that I've never tried myself, but I've seen others have a lot of success with is crowdfunding in the earliest stages, where there were a number of very big rounds in legal tech that were $5+ million over the last couple of years, where either they couldn't or decided not to raise money from more traditional VCs. And I think that has a lot of benefits because you can take smaller checks. I don't know what the regulatory landscape is in Australia. But you can take smaller checks. So it's not like you need to find an anchor who's going to put in several $1 million, but you can build it up from smaller investments. That allows you to turn your customer base also into potential investors and really create alignment there. Again, never done it myself, but I have certainly seen a lot of companies I leverage it, and I've talked to founders who've done it and have felt like it allowed them to really retain control of their business. It allowed them to set their own terms for their round. So they took less dilution. It enabled them to turn their power users also into investors and really deepen that relationship with them. I think there are drawbacks too, right? I mean, part of it can be very helpful to have bigger institutions on your side. And we have, you mentioned having larger corporations invest in you. And we've had 2 corporate VCs come into Priori's syndicates, both through Hearst Corporation and through Thomson Reuters. And now they both did it through, existing like early stage funds that they have created, but they didn't invest in us for, they're corporations. They're acting in their self-interest. They're investing in us because at some level they see alignment between their longer term corporate visions and financial visions and what we've created. And that has been extraordinarily useful to us beyond capital itself. It's meant that, we have large companies with all the resources of large companies that want to do everything they can to help us. And the benefit, if you are going down, I really think there are tracks. If you're going down a VC track, having VC investors earlier can be very beneficial to helping you shape the business in a way that is going to be attractive to future investment.
I just want to go back for a sec to the crowdfunding question. Do you think that best suits those businesses that are very strongly purpose driven, or do you think that it's wider than that? So
I think empirically it's wider than that. Yes. In terms of what I've seen, I think there are, maybe the crypto crash is going to have changed all of this, but I think there was a while where everyone wanted to be an investor. Yeah. Everyone wanted to turn their $10,000 into $10 million by getting into, Airbnb at the right moment. And so I think there was there were a lot of businesses that weren't purpose driven, but were able to, I think, really tap into that zeitgeist and get people, there were people who believed in their services, who used their services, who bought their technology, were interested in it for some reason. But I think that, and perhaps the moment is past now, but I certainly, it certainly felt like it was in the air, at least in the US startup ecosystem.
Yeah, absolutely. Janaya, I want to come to you with this next question first, and we've touched on it, both of you have really, in a bunch of different ways, but I really want to address it squarely because it's such a critical question in funding. And that is this: what are funders really looking for? And what I'm asking you here is almost the checklist of what you're going to need to have before they're going to kind of, you know, part with their money. And I guess tied into that is, what do you see? What have you seen in that way of things that people that have done it really well, they've got the checklist all together, or the ones that have done it poorly, and what are the big gaps that they're not addressing fairly consistently, and it's, if you like, really limiting their chances of getting funding?
Yeah, so there's a number of things, and you know, both Basha and I have said numerous times, understanding your value proposition.
Absolutely.
And that's number one, is really knowing, being able to articulate that, being able to understand what or being able to demonstrate what the business is, what value you're adding, but also what value the investor's going to add, if any.
So does that mean, Janai, that you've really got to kind of rock up with a business plan? It's correct. Really, okay.
Yeah, and it needs to be, you know, a very, very well structured, well sorted. You've, you know, in an ideal world, you've done your own due diligence on yourself. Right. So, you know, you've got your financial records in check. You know, it's done in a structured way, even down to making sure your actual corporate structure is right in terms of entities and trusts and all that sort of thing. You want to make it easy for a business to invest. So if you're, for example, got a trust structure which has its great benefits from a tax point of view, but doesn't make it easy for an investor to come in and contribute equity. So, you know, you need to think about, you know, whether you need to restructure your business to get equity investors in, for example. But doing the due diligence on yourself and your own business, you know, making sure you found all the skeletons in your own closet. You know, if there's any, you know, historic tax issues that they're resolved, or it's being dealt with. You know, are your financials representative of the business? Do you have personal expenses going through your business, which really, that sort of thing needs to be really stripped out. It needs to be looking at very clear, very, very up and down the line, because those sorts of things do make it difficult. And also they tend to make the business look a little bit more amateurish. You know, you want to be perceived as a very professional business. And then going forward, it's being able to articulate, you know, what the plan is going forward, how you expect, you know, if you're saying, I'm going to do $1 million revenue next year, 5 million the year after, 10 million the year after, how are you going to achieve that? Understand the steps and processes that you need to put in place to actually achieve that, but also what the cost base that you have and what resources you need to be able to achieve that, and therefore how much funding you need. But be realistic about it. I think, you know, going back to the unicorn concept, you know, the amount of times I've seen businesses saying, oh, we're going to triple our growth in 1 or 2 years, because, you know, the market is this big globally and we're going to tap in, get 5% of that market. 5% of some markets is massive, and it's just may not be achievable at all. And so I think there's got that, you've got to take that reality check on what you're actually presenting. And as part of that, I think it's really important, and, you know, my focus is on valuation. So is actually making sure your valuation is sensible and makes sense. And therefore, you know, as a consequence of that, you know that if you're getting an investor in, how much that you need to dilute for, you know, the amount of funding you need. And, you know, going back to the earlier points around, well, what's the role of a funder? Are they to partner with you to help you grow the business, or are they just a source of cash?
Yeah, absolutely. And Basha, what are your thoughts about that? I mean, what's the checklist that you found that funders are looking for? Because you've been through this a few times now. And what did you learn, I guess, from that process that you did well and maybe not as well as you might like to?
Yeah, many lessons to be discussed over drinks one day, but while we're here, you know, I would say I think Janai is absolutely right. Once you hit the Series A, my experience in the pre-seed and seed rounds is that it is a lot more like, what way is the wind going? It is about investing. And I think this is to get back to women raising money.
Yeah.
I think that is a set of behaviors that reinforces stereotypes about what a strong visionary leader looks like. So often in the pre-seed and seed rounds, I agree, absolutely, you need to have your vision buttoned up. You need to have a financial plan, but they're not doing that much diligence mostly in the earliest stage rounds, because a lot of the companies don't have that much to diligence. There isn't that much there. And so what are they deciding based on? They're deciding based on who the founders are, whether they see the founders as the kinds of people who could lead a large business and who are going to have the gumption to get it there. And they're trying to understand the market at a high level. They're trying to understand competitors at a high level. But they want you to have a projections model that is sensible. But I think that early stage investing is a lot more art than science. I think that it flips when you are raising, maybe even like a proper seed round versus a pre-seed round, but certainly when you get to a Series A. But we had just a couple of anecdotes. When my co-founder Mira and I, both women, were raising in 2017, we had a conversation. We're raising $2 million, something like that, not very much money. And we had a conversation with an investor who was like, I like your business, your numbers are good, your traction is good, it's a good market, but my spidey sense just isn't tingling. You're like, ew, first of all, please keep your spidey away from me. But second of all, it wasn't, it was just about a gut feeling. And, there was that HBR article a few years ago, I don't know if any of you saw it, that described it, they'd observed venture capital pitches of women and men raising. And the kinds of questions that women were asked were fundamentally different than the questions that men were asked. Men were asked questions like, what's your vision? And there were softballs, and women were asked, tell me about your CAC to LTV ratio and how can you justify this expense or that expense? And I've never been a man raising money, so I can't speak to the comparison, but I can certainly say that the kinds of questions that women were asked very frequently in those earliest stages. And then on the flip side, there are times when it's benefited me. There have been investors who, I was introduced to very warmly by someone who is successful, who said, I think Basha is a fantastic entrepreneur, you should invest in her. And at the earliest stage, sometimes they were like, great. Sounds good. Like, what's the round? Let me write a check. And so I think there are a couple of early stage funding problems, as it relates to women and minorities. And the first is this sort of like that there isn't a track record to go on. It is very much about who you are and who you know. To that point, I talked to a founder who had raised an $100 million seed round on a $1 billion valuation or something absurd like that. And, when I asked how he did it, it was all about relationships and the connections. And he'd been very successful in his career and had, run successful other businesses, but it wasn't based on the business. It was based on who he was and who he knew. And that does amplify bias. And then the second is that women routinely report lower valuations than men do in early stage rounds. And that boxes you in as you go. If you get if you dilute yourself too much in your seed round, it makes it harder to have follow-on capital at every stage, because it's more impactful to your own equity ownership. And so I think those problems really, really compound. But my experience at the early stages is it is very much sort of about social networks, and then the narrative flips to the A.
Janai, I just wanted to ask you just to pick up on particularly the last couple of points that Basha was making about whether or not there's differences that you see between how women and men present their business case, I guess, in terms of funding, and particularly because this is aimed at a women business leaders and founders audience. Any thoughts or comments to add there?
Yeah, look, I mean, to be honest, I probably don't see the breadth of it because we see fewer women, to be honest. But, I think what Basha was saying is absolutely correct. The valuation, even just the way the valuations are presented, tend to be more conservative and less ambitious. And so, and there's a tricky balance, and, I'm naturally conservative. So, but there is a tricky balance between being conservative and knowing the value. And so it's not something as simple as saying, oh, well, and also taking no for an answer, I think, is probably one of the other challenges. You get a knockback and it's like, okay, well, that investor said I'm not worth 10 million, that I'm only worth 5 million. Oh, that must be true. And so it's actually sort of, if you do know what you're after, and hearing Basha's point around, particularly early stage, it is challenging. But I think there is an element of that comes into play, that, a knockback can be taken not as that funder wasn't right for me. It's, oh, okay, I got my value wrong. And I think that's probably an element. But look, but I also think there is a very strong point about that network. The network is key. And interestingly, I've seen a startup business, not in legal profession, where it was a husband and wife team, and in actual fact, they were highly successful in their funds, more because they created a media presence in their business, and often the wife was the face of the business and talking to media, to different journalists around what they were trying to achieve. And as a result, I think that was quite a clever way of going about it, that whilst it was a husband and wife team, she was the face, and she was the one that articulating what the business was. The husband was more the technical person. But as a result, they've actually been highly successful in fundraising. And whether some of that's the element of just being out there and, being out in the media, being out, putting out thought leadership constantly, and so you become known as a brand.
Absolutely. I want to pick up on something that both of you have been mentioning as well, which is, I guess, investors taking a stake in your business. And, you've touched on a few really great points there. And from what you've said, I've taken two in particular that, when you're kind of looking for an investor might be a process, as you progress and as your business grows and expands. But the other one is this thing around investors bringing, I guess, a network or connections that can be helpful as well. But I'm wondering if there's other points about investors that are worth kind of thinking about here. Is there a critical mass, and what does that look like before you might look for someone? And really, what are the considerations? What are the things that you need to really be focused on for identifying a fabulous investor, I guess? And I'm thinking here probably beyond that they will come with money. Are there other things that have to be considered? Because the money could come from a bunch of different places, but you're not going to choose everybody. So what do you do about that? How do you determine how much of your business you're going to give away, for example? And I might go to you first on that one, Basha.
So I think in terms of how to diligence an investor, it is extremely important. We had a term sheet back in that 2017 round again, where we got on the phone with the investor and we were talking about the business, and he said, I think you're overpaying everyone. You need to, if we do this deal, we're going to ask you to cut everybody's salaries. And I said, what are you talking about? Like, we're not, and he was like, well, typically we see, you can hire a marketing person for $60,000. And I said, everyone on my team has a law degree. They left a career where they were making several $100,000. We're not paying, like, we will not be able to retain our team if we take this deal. And then he looked going down and he said, and in December, looks like you spent $1,000 at a bar. What was that? Holiday drinks.
Wow.
And, it was a very hard decision because at the time we didn't have any other deals on the table, but we decided not to take it. We decided that, needing to close the business would actually be preferable to working with this set of investors. And so, it really is about finding a partner that you're aligned with, that you like spending time with, whose advice you value and you think is useful, who comes with subject matter expertise that is relevant to you and to the business that you're building. If they're getting a board seat in particular, I would highly encourage you to reference them. They expect you to ask to speak to a couple of other companies they're on the board of. And if they're not happy to provide that, that should be a pretty significant red flag to you, because you're getting into a very serious business relationship with someone. They're going to be the person who, when there's a deal on the table, they're going to be on your board telling you what your exit can or can't be. I've talked to many founders who've had investors scuttle 8-figure exits for them, and 9-figure exits even, because it didn't align with what the investor wanted. Because if the investor bought their shares at X and they need a 10x return in order to go to their LPs, but for you're going to make $100 million, like your interests aren't going to be aligned. You need someone that you really want to work with and really want to be in those difficult conversations with. So I would certainly encourage everybody to do as much diligence as they can.
And lots of thought around all the benefits that you're going to give as well, I guess, because it's interesting, isn't it? Because you've probably grown your idea and your business with folks that are very close with you, but now you're going to bring in somebody that you don't actually know that well, apart from the diligence that you'll do. So yeah, incredibly important. And Janaya, your thoughts about that? Is there a fabulous investor profile checklist?
Look, I think, it's really very similar to what Basha said, that, it's very much around making sure your goals are aligned, your values are aligned, because you might as well just separate before you even start if you don't have that alignment, because you are going to have to sit with them on the board table, work with them. But also I think it's understanding, what value they're going to contribute. So if they're going to create introductions, open up markets for you, if we use the example of the vertical, are they going to provide you an avenue to get your product to market or your service to market? Then, that's a key part of it. But also the value and, to Basha's point, the exit strategy, they need to be absolutely aligned. And it needs to be someone that you can have those tough conversations with, that, and I think in all of that, and a group of lawyers will probably agree with me, a really good shareholders agreement goes a long way. And, we see a lot of issues coming out of not well-written shareholders agreement, and I'm sure everyone listening to this would fundamentally agree with that. And so, by doing that, you're actually understanding, what the roles are to a certain extent, not from a legal perspective, but I think actually understanding what the roles are from an operational perspective is really important as well.
sadly, I have to start wrapping us up, but I wanted to end with this question to both of you. You're both really experienced in this realm of funding of businesses, obviously from your various perspectives, but I'm wondering, in terms of paying it forward, I guess, and offering some words of wisdom, what's the thing that you really want people to have in front of mind when they're thinking about funding for their business? And it might be something that you've already raised that you want to reinforce, or a lesson that you've learned the hard way, or that you've seen, a mistake that you've seen over and over again that you would encourage people to put at the top of their list. So what are your parting words of wisdom, I guess? And Janaya, I might start with you on that one, if I may.
So, and I keep saying this over and over again, knowing and articulating your value proposition, but also on a slightly biased note, get advisors, get people that know the stuff that you don't know.
Yeah.
Because you can't be an expert on everything. So if you are looking to raise capital, get somebody that can represent you, because, if that's not what you're skilled at, it's best to get the experienced people in there. I might be slightly biased on that front, but it is a way of, I guess, and taking the load off yourself while you're trying to run your business. Because at the end of the day, your role is to run your business, and you don't want to be distracted from, by, an equity round without having the right advice in place.
Yeah, I mean, obviously stay engaged because it's your business, but get that wonderful group of advisors and specialists there to support you. Great advice. And Basha, last word for you.
Just like they say that history is written by the victors, the prevailing narrative on VC fundraising is written by the people who've been the most successful. But it is hard. It's a slog. I've talked to well over 100, probably over 200 investors across our 3 rounds. And almost all of them rejected us. And I'm the kind of person, probably like most of you, who haven't been rejected altogether to that much in my life. I did well in school. I been rejected, of course. Everybody has, but never by 200 people in a row. And that's demoralizing. And I think that to be prepared for how hard it is, what a slog it is a full-time job. And the VCs all meet on Monday. And so if you're really out there, you'll get 10 rejections Monday night.
Yay!
Right. But the flip side of that is that it only takes one, and you really have to keep that front of mind. And I wish someone had told me how hard it was when we started out, and because you go in and you hear you hear that narrative that in the garage building something, and then it just poof clicked into place. And I think that if you did a survey of 100 founders, you would find that's not how it happened for 99 of them, but it was all about grit and perseverance.
Yeah, absolutely. And I guess resilience in a big dose of resilience as well, right? Yeah. Thank you so much. I mean, it's fabulous to have you here today, and thank you everyone for attending. I know that Basha and Janaya will be found on LinkedIn, if not in many, many other places, and would be more than willing for you to reach out to them and to have a chat if you would like to. And of course, you'll find us at the Centre for Legal Innovation in all of those same places. So with all of that being said, thank you very much. As I say, this is the last in our series for 2022. So let me also take the opportunity to wish you all very happy holidays. Thanks again, Basha and Janaya. Lovely to have you and lovely to see you.
Thank you.
Thanks so much for having us.
Appreciate it.
Bye. Bye, everyone.